Welcome back to Alternative Angles, a Fidelity podcast where we hear from investors about strategies outside the realm of conventional stocks and bonds. I'm Steve Rosen, and I'm your host. In the early 1950s, television audiences were captivated by Your Show of Shows, Sid Caesar's groundbreaking variety program. As legendary as its riotous performances, so is the scriptwriting process, which became the model for modern television comedy. Imagine a room full of outrageously talented writers pitching quirky sketches, debating what worked, with Caesar then deciding what belonged in the show and cutting out what didn't. Only the best combination of ideas made it onto the broadcast. Just months before Caesar's show aired, Alfred Winslow Jones pioneered a new approach to portfolio construction that laid a path to today's complex alpha capture and centerbook platforms. And in a way, there's a parallel between the algorithmic processes of these quantitative investing systems and the controlled chaos of Caesar's writer's room. Competitive investment teams supply a mashup of trade ideas via paper portfolios. The alpha capture program assesses and culls the submissions, and then the centerbook manager systematically distills them into an optimized assemblage. Just like the writer's room created your show of shows, think of an investor's room curating your portfolio of portfolios. To talk us through these methodologies and Fidelity's unique approach, I'm joined today by Gil Haddad, the company's Chief Investment Officer of Advanced Strategies and Research. Gil has a PhD in mechanical engineering. He spent his career in and around data science, and for about the last decade has worked as a quantitative investor. Supported by data scientists and quantitative researchers, Gil plays a leading role in the systematic effort to harness Fidelity's proprietary fundamental data, alternative data, and quantitative capabilities in new ways to produce pure alpha strategies for investors. Gil, welcome to the podcast. It's really great to see you.
Great to be here, Steve. Thank you so much for having me on this beautiful Boston day.
Of course. So I want to kick off with hearing about your background. Tell us about your career and how it was that a guy who started out working for an energy field services company ended up as a quantitative investor and researcher.
Absolutely. I feel very, very fortunate, Steve. But let me tell you the brief history there. I started my grad school studying machine learning for the forecasting of remaining useful life of industrial equipment. And the applications back then was how to use data from sensors on industrial equipment to forecast the life of jet engines, wind turbines, and so forth. And it was sponsored by an industrial company. From there, I was hired to an oil company. Their interest was how can you use data and models to forecast the remaining useful life of equipment? It was such a fun job. I had a blast. We would go to West Texas, sit on the well site, figure out how can you take data from frac pumps, and then create models to forecast the life of these pumps. It was such a fascinating job. We did it across a number of oil service equipment, and then back then there was no such thing as data science. We used to call ourselves information scientists. This is before even the data science term was even coined. This was around the onset of alternative data in the hedge fund world. And then I was contacted by a hedge fund, multi-manager hedge fund out of New York, and we started having these conversations. And what we quickly realized is the data and the applications are very, very similar, or there's a lot of similarities and parallels between them. And then this is when I moved to the first hedge fund. And then it was a fascinating move. I fell in love with it, and I think I found my passion, my calling there. The mandate there was how can you take data or alternative data and then process it in a way and then forecast KPIs that matter for the portfolio managers and the analysts. So we would work very closely with PMs and analysts, understand what's driving the stocks, what does the market care about, and then building these forecasts. It was phenomenal. From there, I moved to another multi-manager hedge fund, but then the mandate was not just to build the models on top of this differentiated data, but to also invest on it. This was a phenomenal opportunity. I had an amazing time there. And 6 months in, I became the head of research for the team. And then after a couple of years, I started leading another effort within the center book, trying to combine quant and fundamental. And this is how sort of started in energy, ended up in the hedge fund and the finance world now.
Interesting. I too was educated as an engineer, but I never made it in the field beyond a couple of summer internships. So I'm glad to see that you kicked it off that way and then have come into investing. So to continue on your career, you've joined Fidelity. It's a firm that's a highly respected asset manager with a long track record of demonstrated success in fundamental research and portfolio management. But having, as you said, spent a significant part of your career at these large multi-strat hedge funds, what was the appeal of joining Fidelity?
So for the past 10 years, there's something that's been driving me, and I observe it as a big gap in the marketplace to be able to create differentiated strategies combining quant and fundamental. And this is sort of the type of problem I've been thinking a lot about over the last 10 years and spending a lot of cycles to work on those. And as I was talking to Fidelity, the pitch was Fidelity is sitting on the richest fundamental data asset on the street. When somebody makes it such a bold statement, you would listen. And then concurrently, Fidelity was launching the QRI, the quant business at the firm. The opportunity was to come in and then create systematic strategies trying to combine quant and fundamental. That seemed an opportunity too good to pass up. Now, 4 years into the job, my conviction has only increased that Fidelity is truly sitting on one of the richest fundamental data assets on the street. And I'm sure we'll talk about it today.
Yeah, of course. But before we get there, I'm curious, given the firm's history as a fundamental manager, did you encounter any pushback when you came here, given that your approach is very different from the firm's history?
Steve, when you're creating something new at a well-oiled machine, it means you're resisting both gravity and history.
Okay.
And the firm has been incredibly successful at what we do. We've been in the business of 75 years doing fundamental research and strategies. And we've done incredibly well at that. So naturally, there's always challenges and frictions by creating something new. However, it's always whenever in hindsight, whenever we find a challenge, it turns out that it's an opportunity for us to be able to communicate, educate our partners, and then bring them along the journey. Our partners have been incredibly helpful. We work very closely with the equities department, just as a byproduct of the strategy that we work with, which is leveraging fundamental research from the equities department. They have been incredibly supportive. They have been great partners in terms of helping us with the data, helping us understand, giving us constructive feedback on the signals and the strategies. And then we also now, after we created all the strategies, we share back with them. So it's been a great partnership along the way with them.
Yeah, interesting. Sounds like a very cooperative means of working together. Now, I want to delve into the topic, say alpha capture programs. They've been around for decades, but to set the dialogue for the strategy, how would you contrast your system with some of those earlier ones or those of the more traditional alpha capture managers?
So you highlighted in your introduction about the first hedge fund from Alfred Winslow Jones, and this is really the first incarnation of a alpha capture strategy. And if we anchor on that for a little bit, the genesis of it is you have a number of idea generators or a number of alpha streams that you would hope to be independent and uncorrelated. And then those get funneled into a portfolio where a portfolio manager is making a judgment on which ideas to put in and which ideas to scale up or down. And then that, as a result, you end up with the first iteration of alpha capture. Now, I want to draw the distinction here between different types of alpha capture strategies. That form is what we call external alpha capture because you're taking ideas from external sources. And then that particular effort has evolved significantly over the years. And then there's a couple large hedge funds that specialize in those strategies, and then they're pretty successful at it. And the idea is you take ideas from sell sides or from contributors from the market, and then you combine them in a way that that creates risk adjusted returns. Over the last 15 to 20 years, we saw the rise of the multi-manager hedge funds. And then if you think about the construct of those businesses, you have a number of risk takers and in the form of portfolio managers supported by a number of analysts that are generating alpha. Those uncorrelated alpha streams or low correlation alpha streams, when you put them together, you end up with a higher sharp portfolio. And then it allows you with the ability to do few things that improve your capital efficiency and for you to generate more alpha. And then really that program has been championed over the last, I want to say 15 years or so by the large hedge funds. And then since then, a number of participants have attempted to be inspired by that program to do something useful with it. Now, if I take a step back, you have the external alpha capture and you have the internal alpha capture. The similarities are you have independent alpha streams where you combine them together in a thoughtful way for you to generate your returns. We so happen to have an incredible source of alpha within the firm. We have fundamental researchers and a centralized equity research department. We have more than 50 portfolio managers, and we have differentiated data sources. This gives us the ability to create alphas from these different data sources and put them together in a very thoughtful fashion for us to be able to construct portfolios to meet our customers' needs and demands.
Okay, so tell us a little more about what types of alpha signals you're extracting from Fidelity's decades of fundamental research and its portfolio management, and tell us, why does the historical data set matter if it seemingly is stale and out of date?
So let's start talking about the underlying data sources that I think is a unique differentiator for our alpha capture strategy. I'm happy to draw the comparison with other center books as well. In our alpha capture strategy, our mandate is to take proprietary and differentiated data from Fidelity and then put it together in these portfolios. The proprietary data for us consists of Fidelity fundamental analysts and fundamental portfolio managers, and the differentiated one is the alternative data. I want to talk in a little bit more detail about each one of those sources. On the fundamental analyst data, Fidelity has done this amazing job throughout the years at collecting and storing data throughout the life cycle of the idea generation from our analysts. So what does this mean? An analyst goes, meets with a company CEO or CFO. We know who they met with, when they met with them, and the note they write after the meeting. Then they update their financial model on that particular company. We store and archive the KPIs, the EPS estimate, and so on. Then they go write their note on the security. And then the note consists of specific paragraphs and their views on the security. For example, the 5-year outlook, the specific risks that they're learned about doing research, that's collected. It also has a rating associated with it. It goes on a specific scale from strong buy to a strong sell. That's collected. Then it has a number of flags. For example, is it a long-term winner or a long-term challenge flag to tell us, is this a company being disrupted or a disruptor? We also capture that. Then they go update their paper portfolio that is based on their own coverage. All of that information is captured. Now, given the sheer size of Fidelity and the universe that we covered broadly anywhere between 70 to 85% of the broad indices. So we end up with a very, very broad coverage from our fundamental analysts. Now, take this very broad coverage and then take the depth of the data that you have at each and every point throughout the life cycle of the idea generation, add to it the dimension of going back for more than 20 years, you end up with this incredible data asset that exists within the four walls of Fidelity that no one else has. And that allows us to create incredible signals to generate alpha. So that's the first source. The second source is the PM data, and that's really anchored on what we call the enhanced fundamental ETF, whereby we take a collection of portfolio managers, we take their collective wisdom within a particular style type of trading, for example, large cap core, large cap growth, and then we combine the ideas to represent what are Fidelity's best ideas today within the large cap growth complex, for example. Now, why is that differentiated? Because it only exists within the four walls of Fidelity. Again, it goes back for more than 20 years, and we have a good understanding of the investment philosophy of the portfolio managers. and that renders it an incredible data asset for alpha capture. The third one is the alternative data. While not proprietary, because you can go buy it on the open market, it is truly differentiated. And then the differentiation there comes from the firm's ability and propensity to spend significant resources on alternative data, and then also being able to support them with a team of associates that specialize in alternative data, alongside a team of engineers that allows them to enable and ingest all these data assets. So over the last 4 years, we've increased our spend by more than an order of magnitude for us to be able to compete with the best money managers out there. And has become very important because we're fighting for the same alpha. And if you don't have access to these the best alternative data sets out there, you're fighting with your hands tied behind your back. And this is really the belief that we need to invest in this particular data asset. So you end up with these three data sources for alpha: analyst, PM, and alternative data. Each one of them allows you to create signals, and then you put them together. But I want to address your second question. Your second question is why historical data is important, because it's there. Uh, Historical data is in fact extremely relevant for this type of exercise, because when you want to measure the efficacy of any signal in your data, you want to go as far back as you can to be able to test whether that particular data has alpha in it or not. So that's one component. The other component is what we call point in time. It means that you want to measure the efficacy as the data was generated way back when. Meaning that if I'm looking at an analyst rating, I want to understand what the rating is on a particular security on the day it was generated in 2010, for example. So what that allows you to do is to get comfort and confidence around that is the data efficacious? Does it allow me to generate alpha? And then that helps you to put it in the portfolio. Last but not least, the depth of the data in terms of on the time dimension is also very relevant, because it allows you to look at different market regimes. Now, if I look at the last if I look at the last few years, we've been and since COVID, we've been in a very particular market regime. Now, one question you want to might ask yourself in research: what happens to a particular basket of stocks when interest rate goes down or when interest rate goes up? Having the ability to look back in time and understand what happens to a particular signal on a basket of stocks when something changes is an incredibly helpful thing to have.
You really have great tools to have confidence in these signals, but nonetheless, there could be statistical noise. So how do you sort through that, and how do you have confidence in either the persistence or the decay of the signals?
So you're touching here on two very, very important topics for any quantitative strategy. And I will separate them between confidence and persistence. And then on the first one, it helps to look at it from a process perspective. In any quant strategy, you ought to have a very robust process that allows you to test your hypothesis at different nodes, and this is what gives you the confidence. So we break down the process between data, infrastructure, signal creation, and then you have research hygiene and analysis afterwards. So the data, there's a number of prerequisites. One, you need to have point in time data, as in you need to archive it and store it as it was generated on that particular day, and not to avoid look ahead bias. And then you need to have efficacious data. You need to have differentiated data, and then being able to do that in a diligent fashion is not an easy feat. Then you have an infrastructure. The infrastructure is the ability to process that data on a daily basis, being able to archive it and store it, and then allows you to go back and recreate any signal you want at any point in time. Then you have the signal creation. The signal creation is really driven by coming up first with a fundamental thesis on the data. Let's put it in the context of an example. You take price target from fundamental analysts, and then what you want to do there is you have a thesis, and that your thesis is, for example, I believe that price target on this particular universe is predictive of future returns. And then that's a oversimplified thesis here, just to put it in the context of an example, and that you can test. You test it on your infrastructure. That allows you to look at all the signals in the same fashion and then test it in a repeatable way. So that's that signal creation. Then you have the research hygiene and analysis. And then I cannot overstate how important that is. Meaning that within quant strategies, there is a set of best practices that ought to be followed by any quant researchers. For example, avoiding look ahead bias, separating in sample and out of sample period. So, what does it mean? When we take this particular signal on the price target, you want to test it on a specific period of time that is less than the total period of time, naturally. So let's say if you have a data set that spans 10 years, you want to test it on 7 years worth of data. And then you measure the efficacy of your signal on the 7 years, and this is what we call the in-sample period. And then you want to get the confidence on that particular period before you actually test it on the out of sample, the remaining 3 years. And then this separation between in sample and out of sample is one of the things that we look at in a research hygiene, and that's very paramount in these processes. But also the next step that comes after it is, how do you look at the signals, and then how do you evaluate the signals in a way that gives you the confidence that this alpha is actually durable, this alpha is capturing a phenomena that is mispriced by the market, and then having the right tooling for you to look at all your signals in the same way is very important. So that addresses the first part of your question, which is the confidence. And then that allows us to separate the signal from the noise. The persistence is a very different concept within our construct, meaning that how do you get the comfort that what worked in the past is going to work in the future? Now, I want to re anchor it back on our sources of alpha here. If you recall, the sources of alpha are analyst data, PM data, and alternative data. Now, the persistence of the alpha is largely driven by our fundamental data, predominantly the analysts and the PMs. So as long as you believe that the firm is going to keep on investing in hiring and retaining the best associates in our fundamental equities research department, then the persistence of the signal is going to remain there. And I have a hard time believing that after 75 years, this is going to change anytime soon. As you know very well, Steve, this is one of our most prized assets in the firm that we keep on investing in, and then we take pride in.
Yeah, I would agree. And the tenure of those analysts and portfolio managers working through a very consistent process through time, I think, to your point, adds tremendous value. But now moving to the third leg of that stool, alternative data. Tell us a little more about what kinds of alternative data you use, and does it complement the fundamental insights, or does it uncover different alpha signals that the fundamental research doesn't necessarily find?
So, alternative data, let's start by defining it, is in the broadest sense of the word, it's any data set that is not fundamental. Now, that might be too broad here, but generally speaking, alternative data is exhaust data sets that is predictive of fundamental KPIs for companies. So let's talk about a couple of examples. Today, you can go buy a credit card data that's widely available on the street that gives you the sales for different companies in a particular universe. And then that credit card data is generated from the point of sales, and that is indicative of top line revenue for a subset of companies. Now, of course, we go through the diligence process of making sure that it's compliant, it doesn't have MNPI, it doesn't have PII, and so on and so forth. We have very, very strict controls around that. But then we get a sample that is statistically significant to forecast the fundamental KPIs of the companies. Now, one data set by itself may not be very insightful, because if you get the top line revenue for a particular company, may or may not matter for that specific stock. However, when you start combining these data sets together is when you can start building a very powerful mosaic. Let's take, for example, a retailer, a softline retailer that sells clothing. Now, For you to understand an impact on a promotion that they're doing, you need to have few elements. You need to have data on the promotions that they're doing, and then that can be done with information that's available on their websites or on digital mediums. Then you need to have credit card transactions in their stores. Then you need to have transactions online through third-party platforms. Then you need to have their activity within their stores, and then that's measured by foot traffic from cell phone data. Now, when you put all this information together, it allows you to ask very nuanced questions, such as, are customers going more to the store after a specific promotion initiated by this retailer? Are the customers going back again, so sort of repeat customers?
Mm-hmm.
Are the customers that are going there increasing their ticket size, meaning that are they spending more at that particular retailer? So that allows you to measure the efficacy of that promotion program, and then whether that's converging into something that they hope to achieve, which is increase revenue and then hopefully increase margins. So, but that's a specific example. Over the last few years, we've spent a lot of resources acquiring data sets and then the talent to bring it on board. And we have dozens of data sets in production that allows us to cover KPIs on more than 700 publicly traded companies. And then we're actively expanding the coverage. Today, we have reasonable views on consumer, technology, media, industrials, healthcare, and then we're always expanding. And a big push for us right now is to go outside the US as well, and then being able to get alternative data globally. But then to go back about this particular data set, the third stool, as you describe it, everything we're doing there is predicting fundamentals. And we always anchor it on how does this data set map to a fundamental KPI for the company? And then how do we get confidence that this KPI is relevant for that particular company? So that this is when it becomes very important. Now, another part of your question is it complementary to the other data sets? So if we think about it for a little bit, this data is generated on a daily basis, and it allows you to do what's called nowcasting. It gives you the views on that particular company within the quarter, and it allows you to forecast the quarter end number, whether it's top line revenue or what have you. And then as a result, you end up with a very complementary alpha stream that is rooted in the fundamentals of the company, that is based on data that you would hope you would have an edge in acquiring and processing it. As a result, it ends up being very complementary to the data generated from the analysts and the portfolio managers.
So is there ever a contradiction between the signals generated by the alternative data and the fundamental research? And if not, fine. But if so, how would you sort those out?
So generally speaking, in any quant process that consists of a multitude of signals, it's inevitable to have contradiction between the signals. And then what you would hope is the ideal way is all the signals are pointing in one direction, and that would be the highest conviction idea. Now, the reality, it's almost never the case. You would have some signals that are very bullish, some are less bullish, some are bearish. And then when you combine them together in the alpha model, is you end up with sort of, take simplistically the average of those signals that are telling you that on average, based on all my signals that I believe they're predictive of future return, this company is going to do better over the next 3 months. And then this is how you end up with your forecast. So that's one type of contradiction that's very common in systematic strategies. However, there's another type of contradiction that is actually beneficial, is when you have a signal from the alternative data and another signal from a PM and an analyst that have a mismatch in horizon. So as I mentioned, is the alternative data is very relevant for nowcasting. It's giving you the view of how the company is doing today. And then you have to look at it and anchor yourself on what's the horizon of the alpha that I'm getting from this alternative data. So a company might be doing very well this particular quarter, but then the reality, it's a terminal company being disrupted by this other industry. So the alternative data is not going to be able to tell you whether this company is being disrupted over the long term. However, the analysts and the PMs are able to tell you that this is a company that's being disrupted because it sits within an industry that is going down, for example. But this particular quarter might be doing very well. And this is where the alternative data and the analysts might give you conflicting views, but then that's a good thing because you can capture alpha over two horizons.
Interesting. So, with all this information at your disposal, where you're collecting signals from research, from portfolio management, from the alternative data, and you can combine them to generate investment ideas. How do all these signals flow together into the construction of the portfolios and to manage the risk?
So let me dissect the process a little bit more. So you have the three main sources of alpha: the analyst data, the PM data, and the alternative data. Each one of those sources is a hunting ground for us to create signals. A signal is a mathematical representation of a fundamental thesis rooted in the data that allows us to test whether that particular data asset is predictive of future return. We took the example of price target from the analyst. Another example would be a rating. And then you would rank your companies in your universe from bias to sell, strong buy to strong sell. And then you would test, is the rating cross-sectioning on my universe predictive of future returns? So that's, for example, on the analyst. And of course, the analyst data allows you to create dozens of signals, and then they can get very nuanced. Is there alpha in the change? Is there alpha in the text? And so on and so forth. On the PM data, we're capturing the fundamental data from the PMs based on their best ideas. And then that's a source of several signals as well. On the alternative data, we create KPI forecasts for the companies within our universe that allows us to create the quarter end number. And that's one type of signal. There's other types of signal that we create. So you have these three sources. Each one of them has several signals coming out of it. Those signals get combined in what we call the alpha model. The alpha model is the collection on all those signals that allows you to take a view on any particular security. So you end up with a model that's forecasting expected return, or alpha, based on all the signals that you have comfort with, that are predictive enough of future return. And then you end up with that, what we call the alpha model. From the alpha model, this is where you can create portfolios, and then you can express it into different portfolios. So we express it in a long-only portfolio, whereby we track a broad index, the MSCI US IMI, and we have a 200 bips tracking and a specific alpha target on top of that. Then we have an extension strategy that allows us to create the portfolio from the alpha model. And the third one is the market neutral strategy. So it's the same alpha model that is based on proprietary and differentiated data that allows us to express it into three different portfolios. Now, of course, each one of those portfolios has its nuances in terms of portfolio construction, but at the meta level, it's a quantitative way to package the intellectual property driven by the fundamental resources at Fidelity.
Okay, now let's move to performance attribution, touch on that for a bit. Do you have a means of differentiating the performance contributions from the fundamental research versus those that come from the alternative data? And do you have expectations for return contribution from each?
So when we look at it and measure it, you can measure it at the input and at the output. At the input, it's pretty straightforward. It's based on how many signals are you creating from each one of those data sources, and how are you combining them in your alpha model. So if I create 10 signals out of each data source and I take an equal weight in the alpha model, this is making the explicit assumption here that I have an equal weight across all three of them. Now, there's a very good reason why you don't want to do that. And one of the reasons would be scale. One of the reasons would be the alpha horizon that you're trying to forecast. So we end up on the input having about 2/3 on the analyst data, and for the reasons of the horizon, the alpha, the proprietary nature of that data, and the rest between alternative data and PM. Not so much in an equal split, but the majority is coming from the analyst data. So that's on the input. After you construct the portfolio and then you weight it in your alpha model, you're feeding it to the optimizer. you're maximizing alpha net of costs, depending what type of portfolio you're constructing. But then, if let's take the example of a market neutral, you're maximizing alpha net of all the costs, including T costs, trading costs, and borrow costs. You end up with a portfolio, and then you can attribute back the sources of the alpha, and then a return coming back to the underlying signals. And then we find a almost equal proportion of the returns generated from the three sources.
So if I'm an institutional allocator who might consider such an implementation, how would I think about alpha capture strategies as a component of my broader portfolio?
So today, if you're looking for a strategy that is systematic in nature and fundamentally driven, that is scalable, that's differentiated, and generating its return from idio risk, this would be a perfect addition to your lineup. So let's talk more about each and every one of those. Now, the systematic nature of it, it means it's all process driven. It's devoid of any discretionary changes from management. So it's a systematic implementation of Fidelity's fundamental IP. So that's the systematic nature of it. The fundamentally driven is a very important element of it, because unlike most quant strategies that are based on factors that are widely known, this is based on fundamental data generated from Fidelity's associates, and that data is proprietary. So there's no other way to get access to that data except through this implementation. And then that renders it pretty differentiated. When we talk about scalable, this strategy allows you to create a portfolio that is scalable, that is additive for our investors and partners. And then last but not least, the returns coming from idio. This is a very important element, is we target what we call the pure alpha in these strategies. So the majority of the return should be coming from a residual risk or idiosyncratic risk, or in the long only from stock selection. So we target 80% of stock selection in the long only. On the market neutral, we target 90 to 95 of the risk coming from idio. And then that is a very nice addition to the portfolios of our partners in the institutional space.
Okay, very interesting. We're getting a little closer to time, so I want to wrap up with some thoughts about the future. I'm curious, do you see opportunities to refine all this data that you're already getting and/or expand into new data sets, say with the goal of improving your model? And then in addition, do you have thoughts about the business and how that could grow in the future?
Absolutely. I have very strong views on both of them, as it
Okay,
happens.
lay them out for us.
uh, on the first one, if I look at two dimensions, the data exploration and data exploitation. Data exploitation means on the data sets that we currently have, the proprietary and differentiated data at Fidelity, how much have we exploited from the opportunity set? I would say, and this is a subjective statement, we're about 60%, meaning that of all the data sets we've looked at, we've exploited 60% of the opportunity set from the alpha. And then there is a lot more we can do there. And we have a very robust research agenda that looks at creating signals from these data sets. On the exploration dimension, I would say we're 50 or maybe less than 50%. So what that means is, within the four walls of Fidelity, there is a lot more proprietary data sets that we can access in a compliant fashion that allows us to create differentiated signals that are additive to this strategy. And again, we have elements on our research agenda that is pushing us to look at those data sets. And I'm very confident that as we explore on both dimensions, these models are going to improve. And then as a result, for the portfolios that will end up in our partners' portfolios will be additive or more additive. So that's on the question of the data sets. On the business, in terms of growth, I'm very bullish on this business, not just because I'm in this seat. I believe there's a big gap between bridging quant and fundamental. Fidelity is uniquely positioned to capitalize on this gap, leverage its very rich history of fundamental data assets, leveraging all the quantitative techniques and then skill sets that we've been adding over the last few years, and delivering for our investors and our partners. And then over the last few months, we've been seeing a great interest from investors. And then this is a corroboration or validation for the concept and the thesis and the belief that the street really values the data assets of Fidelity. They understand the differentiation and they're interested in partnering with us on these strategies.
Well, great. You have a lot in front of you and are doing great work. So I really want to thank you for this conversation. It's been excellent. Here on Alternative Angles, we have a parting gift, which is a coffee mug. And I think I'm going to fast track consideration of you for one to the committee, which I chair and has no other members. So I think you're in a good spot. But again, Gil, thanks so much for your time. I really appreciate it.
Thank you so much. I'm excited for the coffee mug.
This podcast is intended for institutional investor and investment professionals only. Information presented herein is for discussion and illustrative purposes only, and is not a recommendation or an offer or a solicitation to buy or sell any securities. Views expressed are as of October 2025, based on the information available at that time, and may change based on market and other conditions. Unless otherwise noted, the opinions provided are those of the speakers and not necessarily those of Fidelity Investments or its affiliates. Fidelity does not assume any duty to update any of the information. Unless otherwise expressly disclosed to you in writing, the information provided in this material is for educational purposes only. Any viewpoints expressed by Fidelity are not intended to be used as a primary basis for your investment decisions, and are based on facts and circumstances at the point in time they are made and are not particular to you. Accordingly, nothing in this material constitutes impartial investment advice or advice in a fiduciary capacity, as defined or under the Employee Retirement Income Security Act of 1974, or the Internal Revenue Code of 1986, both as amended. Fidelity and its representatives may have a conflict of interest in the products or services mentioned in this material because they have a financial interest in the products or services and may receive compensation, directly or indirectly, in connection with the management, distribution, and/or servicing of these products or services, including Fidelity funds, certain third-party funds and products, and certain investment services. Before making any investment decisions, you should take into account all of the particular facts and circumstances of you or your client's individual situation and reach out to an investment professional if applicable. References to specific investment themes are for illustrative purposes only and should not be construed as recommendations or investment advice. Investment decisions should be based on an individual's own goals, time horizon, and tolerance for risk. The securities mentioned are for illustrative purposes only and not necessarily current holdings invested by FMRLLC. References to specific issuers or securities should not be construed as recommendations or investment advice. This piece may contain assumptions that are forward-looking statements, which are based on certain assumptions of future events. Actual events are difficult to predict and may differ from those assumed. There can be no assurance that forward-looking statements will materialize or that actual returns or results will not be materially different from those described here. Alternative investments are investment products other than the traditional investments of stocks, bonds, mutual funds, or ETFs. Examples of alternative investments are limited partnerships, limited liability companies, hedge funds, private equity, private debt, commodities, real estate, and promissory notes. Some of the risks associated with alternative investments are: alternative investments may be relatively illiquid. It may be difficult to determine the current market value of the asset. There may be limited historical risk and return data. A high degree of investment analysis may be required before buying. Cost of purchase and sale may be relatively high. Stock markets, especially foreign markets, are volatile and can decline significantly in response to adverse issuer, political, regulatory, market, or economic developments. Foreign securities are subject to interest rate, currency exchange rate, economic and political risks. Securities selected using quantitative analysis can perform differently from the market as a whole as a result of the factors used in the analysis, the weight placed on each factor, and changes in the factor's historical trends. Securities lending involves the risk that the borrower may fail to return the securities loaned in a timely manner or at all. If the borrower defaults on its obligation to return the securities loaned because of insolvency or other reasons, a fund could experience delays and costs in recovering the securities loaned or in gaining access to the collateral. Past performance is no guarantee of future results. Investing involves risk, including risk of loss. Fidelity Investments provides investment products through Fidelity Distributors Company, LLC, clearing, custody, or other brokerage services through National Financial Services, LLC, or Fidelity Brokerage Services, LLC, members MNYSE, SIPC, and institutional advisory services through Fidelity. Institutional Wealth Advisor, LLC, personal and workplace investment products are provided by Fidelity Brokerage Services, LLC, member NYSE, SIPC. Institutional Asset Management is provided by FIAM, LLC, and Fidelity Institutional Asset Management Trust Company, and Fidelity Diversifying Solutions, LLC, FDS. Before investing, consider the mutual fund or exchange-traded product's investment objectives, risks, charges, and expenses. Contact Fidelity or visit i.fidelity.com for a prospectus, or, if available, a summary prospectus containing this information. Read it carefully. Copyright 2025 FMR LLC. All rights reserved.